We'll talk about the invisible tax burden faced by the Indian equity investors. From 2004 till 2018, the Indian long-term capital gain tax was zero for the long-term, and short-term capital gain tax was 10% on listed equities. This changed to 10% and 15% till 2024. And just recently, government has increased the long-term capital gain tax to 12.5 from 10, and short-term from 15, it has increased to 20. Low tax rates and high equity returns have resulted in a strong growth in the equity investor base so far in India. The total number of demat accounts have increased from 70 lakhs in 2004 to 17 crore in 2024. This latest increase in the capital gain tax rates came with a smart narrative that capital gains tax rates in India are still low compared to many other large economies. Of course, India has now become the large economy. It's the fifth largest economy by GDP and fourth largest by the listed stock market capitalization. India's capital markets are fairly vibrant with a large number of listed companies and sectors for investors to choose from. Initially, dominated by a few large players, the market is now diversified with a broader base of investors, including retail investors, domestic institutional investors, and FIIs. The pendulum has swung so far that the government and SEBI is now forced to take measures to reduce the heightened activity seen in some parts of the market. For example, derivatives, SME IPOs, etc. So in short, in the pretext of saving the lives of the so-called innocent and retail investor, the government is actually filling its coffers. However, there has been one under-discussed change in equity taxation over the past few years. This has to do with how corporate payouts in form of dividends and buybacks are taxed. We believe this change has more negative consequences for equity investors in India compared to the hikes in the LTCG and the STCG taxes. Till 2014, dividends were taxed at less than 20%, and income from buybacks was taxed similar to LTCG and STCG, which is 0 and 10%. Now, over time, taxes on dividends and buybacks have gradually increased, and now both are treated as income in the hands of shareholders and taxed at the marginal level. For individual promoters of listed companies and HNI investors, the effective tax rate on these distributions is close to 36%, including surcharge and cess. In a matter of 6 years, tax on income from buybacks has increased from 0 to 36% for them. It's a far more material change than the LTCG and STCG tax. To give a perspective, this tax rate is higher than those paid by any billionaire in the US on similar income. The high tax liability, around 36% on dividends and buybacks, may result in reduction in the payout ratios as promoters will look to minimize their tax liability. They will look for creative ways to get this money out. Many companies will choose to hoard the excess cash rather than to distribute it to the shareholders. Some companies may use the excess cash for unrelated ventures or acquisitions without any significant economic rationale. Some unethical promoters will use the excess cash to avoid the tax liability and maybe sell a 100% owned company, which will be private, at an obscene price to the cash-rich listed entity. They will, in the process, pay only 12.5% long-term capital gain rather than 36%. Few personal expenses like private jets and expensive art will be sponsored from the company cash books. Now we and other SEBI-registered PMS companies like us have started looking for investment opportunities having capital appreciation rather than a healthy dividend yield, since the tax implication kills the post-tax returns at the hands of the client. The intrinsic value of the business is determined by the cash flows it generates and distributes to the shareholders. If these payouts are now heavily taxed, it effectively reduces the value of these businesses because the cash payout does not happen. The unintended consequences mentioned above, along with the decline in the intrinsic value of the business, also indirectly impacts the mutual funds and smaller investors in lower tax brackets. A simple suggestion to the government is to reduce the tax burden on these healthy corporate actions of dividends and buybacks.